Stocks open up with a big bang after Friday's close as Maharashtra poll outcome and a rally in the US. Equity shares bulls. Energy, capital goods and realty are the big gainers, while IT and healthcare lag.
In an important constituent shuffle for the benchmark index, the BSE Sensex Zomato will enter the Sensex and JSW Steel will exit the index on the 23rd of December. The swap fuels a rally in Zomato, while JSW Steel is one of the three Nifty stocks under pressure today.
Maharashtra election sweep by the BJP-led alliance powers up infrastructure and realty stocks with significant exposure to the state. Realty experts see a focus on infra spend driving growth for the sector.
And nearly $1.7 billion could flow into Indian equities as a result of the MSCI rebalancing today. HDFC Bank could see its second weight increase in the global index as part of the recalibration. Good afternoon, you're watching Halftime Report here on CNBC-TV18. I'm Hormas Fatakia, with me is Mangalam Malu, and if there is any red that you can find on the screen, please do let us know as well, because it's a very, very deep shade of green, as you could see on the top of our screens. The Nifty is up 1.5%, as is the Sensex. The mid-cap index is up 2%. The Nifty Bank is up 2%. The top sectoral gainer today is the PSU Bank Index, and that is leading the charge on the upside, with every single constituent trading with gains of anywhere between 4% for SBI to 7% and even more for the other constituents. The Realty Index continues to move higher, so it is every shade of green that you could find. PSU stocks are higher, IT stocks are higher, pharma stocks are higher, and there is very difficult to find an underperformer in today's session.
Difficult to find an underperformer, but there are a few, but we won't talk about that right now. The important part is that the Nifty, while it's holding on to gains, it's come off slightly from the 24,300 mark. That makes it important to check the closure in today's trading session for the index as against just the opening. We'll keep an eye out on how that pans out. And most importantly, the broader markets are doing extremely well. 2,000 stocks advancing for just about 450 stocks which are declining. We're speaking about some red. Nalco, after the big run that it has seen in the last few trading sessions, has come in for some bit of profit taking. So currently at the low point of trade for Nalco. Strides Pharma too, similar. It's a big up move that we've seen on this stock for the last many trading sessions, currently down about 4%. If you look at the longer term chart for something like a Nalco, this month itself, and the index was down, the stock is actually up around 8 to 10%, and this year so far, that stock is up 90%. Similar is the case for Strides Pharma, currently down about 4%. But if you look at it, over the last 3 or 4 months, you'll see a big up move come by on Strides Pharma as well. So this Nalco, about 12 months up move is 170%. For Strides, the same is close to around 191 odd % as well. So we'll keep an eye out on all of this. The big supporter on the way up for the index today and on Friday was Reliance Industries, surging after a bunch of brokerage upgrades coming in. And today, this one comes in from Citi. Sonal joins in with more details on that one. Sonal.
Well, yes, a big supporter on the index today. Citi has gone ahead and upgraded Reliance Industries to a buy, and the target has been raised to 1,530 rupees a share. They say that after some time of underperformance that we've seen on the stock, it's time to see an up move, and especially it'll be led by the refining segment. Remember, that was an underperformer in last 2 quarters, but now the risk reward has turned favorable according to Citi. They say margin improvement is expected in the refining segment given that China's competitiveness has reduced in terms of exports. The supply coming in the refining space is lower than what was anticipated earlier. Jio also remains very well positioned to benefit from future tariff hikes. The second thing that would work for them is improving the data pricing and monetizing 5G as well. The retail growth slowdown could continue, however, according to them, for a few quarters. And this is the reason they see that it could lead to 1% average consolidated EBITDA cuts over FY25 to FY27. However, the other segments will make good for that, and that's why they're bullish on the stock.
Index heavyweight supporting the market. Reliance Industries 2.5% higher. Sonal, thanks a lot for that. Now, SBI Card is the other one that's also buzzing in trade on the back of the October credit card data. Abhishek is here with more details. Abhishek.
Well, Homas, it looks like you had a festive season given the fact that industry-wide credit card spends have gone up. So, were you on leave or are you planning a leave? Let me know. Industry data for the month of October shows that the growth rate with respect to issuance of cards have slowed down to about 13% YOY and 0.74% on a month-on-month basis. but the spends have increased massively on a month-on-month basis by almost 14.5% increase in spends, which means that the average spend per card has increased by 13.7% on a month-on-month basis. For SBI card, the card issuances were on the lower side YOY, but it has improved better than industry growth rate on a month-on-month basis. They had a month-on-month run rate with respect to card issuances being up by 1.1% when compared to 0.74% for the industry as a whole. The spends are up 14.9% month-on-month, and their average ticket size or average spend per card has increased by 13.6% month-on-month. So card issuances, they have lost market share on a YOY basis, but gained on a month-on-month basis. The market share is at 18.53% versus 19.08% on a same month last year, and about 18.46% on a month-on-month basis. Spends, their market share has come up to 15.78% when compared to 19.8% on a year-on-year basis, and about 15.7% on a month-on-month basis. Back to you.
Right, Abhishek, thanks a lot for that. So that's about SBI card. IGL is the other one which is in focus. The companies increased their CNG prices in different geographies. Sonal joins in to tell us more. Sonal, also, does this, overall cover the sort of increase that the street was anticipating in the gas prices?
Well, it doesn't. To give you the news, IGL has gone ahead and increased prices across geographies, barring Delhi. So the price hike is between 1.5 to 4 rupees per kg in different geographical areas up north. But remember, they have not taken any price hike in Delhi. That's where CNG prices remain at 75.09 rupees per kg. And Delhi is the biggest market for them in terms of volumes, around 70% there. But do remember, we do have the assembly elections coming up very soon. So maybe ahead of that, the company has not gone ahead and taken price hike. So the real action could be seen after that. But on the 30% volumes, the price hike is anywhere between 1.5 to 4 rupees per kg. That would mean a price hike between 2 to 4.5%. But according to calculations, these CGD companies have to take a price hike between 8 to 10%. So this is not sufficient. And above that, it is taken only on 30% of the volume. So it is not something that analysts were expecting, or it is not something that would maintain their margins. However, volumes could remain constant for them or even grow from these levels. But yes, the street is happy that there is some price hike which has come by. So it could protect margins, but not as much as required to maintain the margins at current levels.
Still 3.5% higher is IGL. Sonal, thanks a lot for that. By the way, the Nifty slightly off the highs of the day, as Mangalam just mentioned, but 50% of those gains are coming from the four heavyweights. HDFC Bank, Reliance, ICICI Bank and L&T are the four that are contributing to more than half of the index upside as we speak, but still 380 points higher on the index, continuing to hold on to some important levels above 24,000. Well, time for a short break. Up next, we'll be joined by Arnab Mitra, the India consumer analyst at Goldman Sachs, to discuss the trends in the consumption sector. Stay tuned, back on the other side.
Welcome back. A bunch of these FMCG stocks doing extremely well in today's trading session, most notably the staples one. So we'll keep an eye out on that. Britannia, for instance, up around 3% Marico has picked up from, the lows of trade. Nestle is doing extremely well as well. So the question is, where does it go from here on? Arnab Mitra, the India consumer analyst at Goldman Sachs, joins in now. Of course, the commentary from companies does confirm that there has been a fair amount of urban consumption slowdown. The question is, does this recover or not? Before we talk about that, Arnab, pleasure having you on the show today. The question is, staples, because a lot of people, after the election results that have come in from both Jharkhand, Maharashtra, as well as earlier Haryana, the street believes that maybe populist schemes are back on track. Typically, when that happens, that is a positive for staples. What does your assessment say on this, and do you think it's a good time?
Yeah, thanks for having me on the show. Great to see you again. So if you look at the staple side of the equation, there has undeniably been an urban slowdown, which most companies have spoken about. However, if you just unpack the data on urban at an aggregate level, there are a lot of different trends that are there. So obviously the absolute top end of urban, which we call affluent India, which we wrote about in our report in the beginning of the year, that still remains very resilient. Categories like jewelry, travel, leisure, those segments have remained very, very strong. There is really a slowdown in the mass urban categories, which is where some of our FMCG names come in. And there has also been a trend of downtrading. So certain categories, for example, packaged tea has seen a downtrading trend. We have seen downtrading in value fashion, where value fashion names are doing well. The rural side of the equation actually has been doing quite okay, Mangalam. If you look at even in the last 6 months, rural has been more resilient. We are doing much better than last year, and definitely has not seen a slowdown in the recent months. I think one of the reasons why rural has been resilient is what you referred to, which is that in the last 6 months we have seen an increase in welfare spending by state governments. In fact, our economics team had put out a piece where they quantified about 1.5 lakh crores of direct cash handouts to women across 8 or 9 states in the last 6 to 12 months. And that's something which is a trend that we are seeing continue, and that definitely does help rural demand remain more resilient. Of course, the other part of the equation is we are probably in a good agricultural cycle. The rains have been good. Hopefully, the agricultural economy should be doing well. So I do feel rural will continue to remain resilient, while some of the urban slowdown could continue in the near term. Staples, honestly, is a little better off than discretionary because it does have a mix of rural and urban. And we are seeing relatively resilient growth in staples, except for certain companies which have a higher dependence on urban consumption.
A couple of more quarters, Arnab. Firstly, good afternoon. Thank you for joining in. A couple of more quarters for this urban slowdown to persist. What are your channel checks indicating? Because now we are past the festive season. A better part of the wedding season is also behind us. What has been the third quarter trend looking like on ground as per your channel checks?
Yeah, so if you go back into why this urban slowdown has happened, at least our analysis, our view, is that it's been driven by two very specific factors in the recent 6 months. One is if you look at the last 12 months, 10 of the last 12 months, food inflation has been running at more than 8%. This is significantly higher than what we have seen in the previous 4-5 year period, right? So that is definitely hurting disposable income for urban consumers, especially mid to low income urban consumers. The second is we've seen the slowdown in unsecured lending to consumers. Again, that affects the same income segment, which is low to mid income urban. Now, any pickup would basically depend on these two factors reversing. If you look at food inflation, it's primarily driven by one thing, which is vegetables. Vegetable inflation has been extremely high in the 20s and 30s in the last few months. And vegetables, as you know, is a demand-supply equation. It's a perishable product. If there's a slight shortfall in supply, prices move up. If supply corrects itself, prices move down also. We've seen that in history. Our economics team actually does believe that we should start seeing a cooling off of food inflation somewhere in the March quarter as the winter crop comes in. The winter agricultural cycle has been good. The rains have been good. So once that corrects, that in my view could be a catalyst for a gradual recovery. As we speak in the December quarter, I do not expect trends to change significantly, but we do not expect it to worsen, but it would probably not improve. And it would be somewhere in the March quarter where the catalyst would be a gradual easing off of food inflation, which leads to the urban consumption starting to come back in. However, the other factor in consumer staples has been this very sharp spike we have seen in palm oil prices in the last 6 months, which is impacting margins of many companies. So as you know, palm oil is used very extensively in soaps, in noodles, and biscuits, and a bunch of FMCG categories. The commodities spike has been extremely sharp in the last 6 months. And as it always has, FMCG companies take 6 to 8 months to pass on pricing to the consumers. So we are also seeing a margin pressure, which in our view is transitionary. And once the pricing increases are taken over a 6 to 8 month period, we've historically seen consumer margins come back to where they were. So from both those angles, in terms of an urban consumption recovery, as well as the input cost pressures going away, I would think that somewhere in the March quarter, we should start seeing those two play out. And therefore, it's a good time to look at some of the stocks which have corrected due to both of these factors in staples.
All right, and come March quarter, you'll also have a lot more favorable base. So maybe optically as well, growth would look a lot better going forward in FY26. Arnab, let's get a little specific on your calls that you have. One on Titan and the other one is on ITC. Titan, you say that competitive intensity perhaps in your view is largely over. I just wanted to understand what makes you think that, largely because, we still have others expanding their retail presence, their offerings, the underlying macro trend of, people moving into lab-grown diamonds. And then you have new age corporates coming in as well, or Indriya, Reliance, increasing their footprint. So your thoughts on competitive intensity for Titan? And the second one is ITC. Is it purely for valuations? Because, other companies, namely Godfrey Phillips too, over the last 8 or 9 quarters has consistently been gaining share in the tobacco segment. So both on ITC and Titan, your call.
Yeah, Manglam, I would not speak specifically on individual stocks, but if I just step back and think about the jewelry industry, like many consumer discretionary industries, is extremely attractive. So all these consumer discretionary industries have high headroom for growth. They play on affluent consumers. There is formalization, unorganized to organized share move. And as a natural consequence, we have seen increase in competitive intensity in many categories in the consumer discretionary side: jewelry, paints, fashion retailing. We've seen a spike in competitive intensity. So that's a reality. Competition is going to be high in these sectors as more people try to participate. Having said that, the industry itself is in really strong tailwinds. So the revenue growth for the overall jewelry industry remains extremely strong, probably one of the strongest within my coverage. We expect December quarter to also be very strong after an extremely strong March quarter. Gold prices recently coming off did help consumption again pick up in this category after festive season. And our view is that if the underlying industry trends are very strong, there is room to absorb more competition. So our view is not that competition is going to ease in any way. Competition will remain high, but the industry growth is good enough to absorb more competition. And of course, jewelry is not a zero-sum game. There's a lot of unorganized sector, and all formal players could gain share here. On lab-grown diamonds, it's a very interesting point you raise. That's something in our discussion with investors is very top of mind. It's something which is not very easy to take a view on today because it depends. Each country may react very differently. But the research that we have done and written about is that historically, what we've seen in other countries like the US is the lab-grown diamond market does become a substantial part of the diamond market, but the overall sales of diamond jewelry do not tend to drop. Consumers actually uptrade the size of the stone as they move from a natural diamond to a lab diamond. And therefore, if the existing players can also participate in lab-grown diamonds, which it has happened in the US, there is no reason to believe that in the longer run, the industry pool of profits or revenue will erode. So it's something that we are keeping a watch on because this is an evolving situation, very early stage for India. But looking at international trends, it would be a change in the industry without probably affecting the entire profit pool of the industry is how we are looking at it.
All right, Arnab, pleasure having you. Thank you so much for sparing time and joining us to take us through your views on the entire consumption sector. Time for a short break here on Halftime Report. Get you a chart check on the other side as to where the Nifty is headed now after this 1,000-point move from Thursday's low. Sudeep Shah of SBI Securities joins in.
India is such an important part of AMD. When we look across our, all of our, global portfolio, it's been a remarkable experience. I mean, if you think about all of the things that have changed over the last 10 years.
You're watching us here on Halftime Report. Perfect time to get you an update coming in from the F&O space at midday itself as the bulls bounce back. You look at all the frontline indices doing extremely well in today's trading session. The broader market is doing a shade better than the frontline index. The Nifty banks leading gains. What's also leading gains are the high beta names. That's telling you that, fear is slightly abating in the system. So you have the Nifty PSU bank up around 4.5%. The public sector enterprise index itself is up around 3%. So 2 times the gain that we're seeing on the frontline index. Then you have the realty and infra names, both of them bouncing back as well, outperforming in an otherwise strong market in any case. This week has a bunch of cues after this up move that we've seen. It's the November series expiry week. Both the Nifty and Nifty bank lot sizes have changed. So, the rollovers will be something that we'll be tracking very, very closely, largely because of this big lot size change. And then come December series, you'll have 45 new stocks in F&O itself. So all those factors will play out all through this week and perhaps the next couple of weeks as well. But what we'll also need to monitor is on the way up. Do we see further short covering? Because there is some short covering on the 24,000 call that started on Friday. That continues today. On the way up as well, 24,100 call writers too are covering their position. So caught on the wrong side, and that's leading to the up move that we're seeing in the market. But on the way up, do we see, some support at lower levels? 24,150 tells you that there would be some support because there is some writing at the 24,300 put. At the same time, there is writing at the 24,300 call. So this is something that I'll be tracking very closely because the market's given up from today's high, even as it's standing with stall gains. 150 rupees available for the 24,300 call tells you that around 24,450 to 24,500, there may be a bit of resistance. Around 24,500, there is a lot of call writing as well. That's the maximum open interest that we've seen in terms of calls. So we'll keep an eye out on this. But talking about individual stocks, a couple of stocks seeing a lot of long positions being added. M&M is one of them, hopeful of recovery in rural India in the second half and pick up in passenger vehicles as well. And the second one I'm looking at is AB Fashion and Retail. Came out of F&O ban on Friday, may perhaps re-enter F&O ban today with the kind of open interest move that we've seen on Aditya Birla Fashion and Retail.
Interesting, right? Out of the ban on one day, back into the ban the other. Mangalam, thanks a lot for that. Let's pose the question to what next for the market. Sudeep Shah, Head of Technicals and Derivative Research at SBI Securities, is joining us now. Sudeep, good afternoon. Thank you for joining in. Well, for a lot of the participants, you may wonder that a 1,000-point recovery from Thursday's low, you might feel you have missed the bus. But what next for the index after this kind of a move? Do you believe that there is a change of trend that has taken place, or once this sentiment impact plays out and then the market enters into a consolidation zone again?
Good afternoon, Hamas. Post that excellent short covering move which we have seen on Friday and a replica of the same today, we feel that the trend would continue to be bullish right now, and Nifty could continue this bullish momentum up to 24,500, 24,550 zone. And within this journey, there would be some consolidation because the move from the Friday's low till today has been too swift. So we could see some consolidation, some retracement back to 24,100, 24,150 levels. But now, even within that dip, the stock-specific moves will be very constructive. So what we feel is that on the downside, as we say that the support is closer to 24,100, 24,050, where the 20-day MA is placed. Now, with this improved sentiments on account of these election results in Maharashtra, we feel that the high beta names such as banking, capital goods, auto, as well as select PSE stocks could now be in focus, and they should be looked upon for the next set of rally when the market slightly dips in between.
So in light of that, what are the stocks that you're recommending? Are there high beta names in your list as well?
Yeah, so one is from the construction space that is Larsen. Now, where we see the way the stock has moved, it was in a range in the last several months. Right now, from the lower levels around 3,500, 3,550, there is a strong up move. The stock has crossed its intermediate resistances, which were around 3,650. And even post opening today, there is no selling pressure here. So on dips, on smaller dips, there is buying that is visible here. So what we feel is that from a next few weeks perspective, the stock should be a part of your portfolio or trading portfolio. And the stop losses here on the downside would be around 3,680. The first target that we are looking out here is 3,900 and the second would be 3,980. The second stock is from the mid-cap space, which is Praj Industries. Now, the price is somewhere around 804. We feel that a stop loss of 780, with that stop loss, the stock could head up to 840, 850. If we see the last few weeks, the stock was consolidating post that big up move. And now, post that consolidation, we feel that breakout is just around the corner. The structure on the daily, weekly, and the monthly time frame all are quite bullish. So on dips, this could be bought with a stop loss of 780, and the targets would be 850 to 870 on the upside for Praj Industries.
All right, take that point. Thank you so much, Sudeep, for joining in and giving us your view on the index and individual stocks. We take a short break, come back, getting more stock-specific action on the other side.
Welcome back. Now, the other big event of the afternoon is going to be the MSCI rebalancing that takes place towards the closing of trade, where BSE, along with 4 other Indian stocks, will now be part of the MSCI Global Standards Index, and changes to the Sensex have also been announced. Vivek is here to tell us more about all of that. Vivek.
Well, that's right. Good afternoon. So when you're talking about passive indices, today is a very busy day, given the fact that post-market hours on Friday, you actually saw quite a few announcements come in. First, let's take a look at the announcement as far as the Sensex is concerned. Zomato will be coming into the BSE Sensex effective December 23rd, 2024, and this will be at the expense of JSW Steel. So Zomato is expecting inflows of over $450 million, and these inflow estimates are as per IIFL Alternative Research. JSW Steel expect to see outflows of close to $250 million. Now, talking about FTSE, this particular review largely alluded to IPOs as well as spin-offs. So 2 companies, Bharti Hexacom as well as Go Digit, will be inclusions into the FTSE indices, and the indices that we're talking about are the FTSE All World as well as the All Cap indices. Now, coming to the main event of this particular afternoon itself, that is the MSCI reject. The rebalancing will be done in the last hour of the trading session today. Expect to see inflows of almost $2.5 billion, which are the 5 stocks entering the index today. Voltas, BSE, Alchem, Oberoi Realty, Kalyan Jewellers. You can see the flows on the screen. Flow estimates are as per IIFL Alt Research. And more importantly, keep an eye out on HDFC Bank. Almost $1.7 billion of inflows expected to be seen in the last hour of the trading session. Now, remember, a whole host of active fund managers already would have made positions, so you would see some amount of unwinding. However, volumes in this particular stocks in the last hour of trade will be very, very high. India's weight in the emerging market index is expected to now reach 19.8%, second only to China.
All right, we take that point. Thank you, Vivek, for that. But rail stocks, they're also a buzz in today's trading session. RITES and RVNL, they've, they're rail stocks, but they're taking the flight today. Vamakshi joins in for more details on that one. Vamakshi.
Well, absolutely, Mangalam. All of these counters are taking a flight today. Of course, there's some rub-off effect coming in from the win in Maharashtra. But apart from that, individual news flows lined out for these counters as well. RITES has received revised estimates for its railway electrification project from Northeast Frontier Railway. Now, the revised cost has been increased to 532 crores from 288 crores earlier. So this bodes well for the company, going with the green for this counter. And in fact, RVNL also, its JV with SCPL has received an LOA from Eastern Railway for a project worth 838 crores. And with this, RVNL share came in at 76%, is at 76%. And therefore, the order value that is attributable to RVNL could be somewhere around 637 crores. And this is for work in connection with construction of multi-tracking railway, broad gauge railway line. And the project is expected to be completed over the next 36 months. So again, positive news flow for RVNL as well.
Vamakshi, thanks a lot for that. The railway stocks recovering from the lows. Remind you, these railway stocks have corrected anywhere between 30 to 40% from their highs, be it RVNL, be it Railtel, be it IRCON, or even IRFC for that matter. Time for a short break here on Halftime Report. On the other side, Manisha Gupta joins in with Kunal Shah of Nirmal Bang. Stay tuned. We'll be right back.
Welcome back. Joining us on the show now is Kunal Shah. He's head of commodities and currencies at Nirmal Bang. Thank you, Kunal, for joining us. And I want to start with precious metals because we did see previous week as a great one. I mean, it was 5% of a jump up in gold, which was the best weekly gain in perhaps 2 years. It hasn't held on there.
Yeah, so we've seen one of the major reasons for gold to rally was the geopolitical escalation of the geopolitical scenario, especially what has been happening with Russia and NATO and the exchange of words. So Russia has been quite aggressive about using new missiles, and there has been a constant confrontation, and that has led to a built-in geopolitical premium. Remember, we've seen rally in gold futures by more than $160 of rally with a stronger dollar. So dollar index in the month of September was trading at 99.70, and from there it has rallied to 108. And we have seen, even with the stronger dollar, gold prices have really rallied by more than $150. So today is a day where we have seen a profit taking. There has been also news that there is a possibility of a ceasefire between Hamas and Israel, and that is also adding to a weak sentiment right now. So my view is still bullish on gold, but expecting a correction or profit taking, whatever terminology you want to put into. I see a bottom placed at $25.80. Even though the dollar remains strong, the entire gold trade is shifted to the east, is shifting towards east, is shifting towards BRICS blocks. The Western investors or the Western central banks are not buying gold, and the BRICS economies are continuously buying gold. They want to come up with a gold-backed currency. So it's a push and pull scenario where the West is buying Bitcoin and the entire East is buying gold and continue to remain long in gold. So the outlook doesn't change. There is going to be a pause or profit taking, whatever you want to put it in that way. We are near December. We are going to see money managers taking profit because they've made huge, handsome amount of money in gold in last 1 year, 1.5 years. So some profit taking on the cards. It can go down to 26.20, 26.30 kind of levels on COMEX. As far as India is concerned, for the December contract, it can go down to 75,800 to 76,000. But those are the levels where I would again recommend investors to start accumulating. The trajectory of gold for the 2025 still remains very positive. We are of the view that gold will test $3,000 in the year 2025. So this correction or this short-term trend is something, one should make a use of it and start accumulating.
All right, we hear you, Kunal, buying into gold. And yes, this year has been quite phenomenal, almost 30% up in this year until now, and further gains anticipated. How are you also looking at the industrial metals now? Because the street is looking out for what the Trump administration will do as soon as the next year begins, whether it is about tariffs or taxes or inflation. How are you looking at all of that uncertainty, and what's your sense, or what strategies are you making for base metals?
So my clear view is bullish. So there are a lot of uncertainties. There are lots of ifs and buts. What if, what not? China will grow, it won't grow. But the intent of China is very clear. By cutting the export duty rebates, what they have been giving to their exporter, they have made it very clear to the world that they want the supply squeeze to take place outside China, and they are okay if there is a glut within the China, because the state enterprises, they have already given permission to the state enterprises to roll over their debts. So I think the state enterprise will come into the picture and start buying metals. So that is to reduce the domestic glut in China. Ex-China, even though right now there is a news that Rusal is going to cut its aluminum production by 250K because there is a shortage of alumina. So alumina prices have risen from 3,500 yuan per ton to 5,300 yuan per ton. So there is a shortage of alumina. Earlier, the cost of alumina was to produce aluminum was 25%. Now it is 50%. So all these base metals are going to move up, just a matter of time. Markets are waiting for what Trump is going to come up with, what kind of tariff, what Trump is going to come for China. And that's the only uncertainty in the market. But the trajectory from here is up, and especially aluminum. So with today, I think 10 minutes back only, there is a news that Rusal is going to cut the production of aluminum. This is very bullish. And I'm expecting, aluminum prices to shoot up from here. at least by another 5 to 8% rally in aluminum. Second favorite will be copper. Copper around 800 rupees is a good value buy. Even though the Chinese real estate market continues to suffer, but we feel that whatever China is doing, their intent is to, their intent will eventually turn out to be higher metal prices. So go long in metals. It's looking very bullish to me.
Well, if this year has anything to go by, we have seen higher metal prices, and going forward, the way the China is strategizing the whole thing, even before Trump is taken over, looks like the metal prices could go higher further from here. Kunal, as always, thank you so much for joining us. So that's buy gold, buy silver, buy metals, as well as a call coming in from Nirmal Bang. But with that, let's go for a short break. We will get you more on markets and stock specifics on the other side.